Michelle's joining you tonight. Okay. All right, let's talk about these rental activities. We got, I don't know, 10 or 15 slides on the rental. So rental activities of tangible, either real or personal property, is automatically passive unless it meets one of the exceptions. All right, first of all, any temporary regulation that's put forward provides exceptions for certain situations involving rentals of real estate or real property not being treated as rental activity. So if it's not being treated as a rental activity, active is subject to, if exceptions applies, the activity is subject still to the material participation. So if the exception applies. So what does that mean to you guys? Almost all of rental activities are treated as passive. All right? Because if you notice, if I go back to this slide, temporary regulations provide exceptions to situations. Temporary regulations. So unless there's something that's set forth that says this is not a passive activity, it's going to be a passive activity. Passive losses are applied after the at-risk. So the first thing you do is figure what's at risk. You cannot deduct beyond what's at risk, even if there is passive losses. Losses allowed under the at-risk are not allowed, losses not allowed under at-risk are suspended, all right, which we talked about already. The basis is reduced by any deductions. The basis is what the item is carried at, all right? That's kind of what I was talking about with my AT&T stock. What is my basis in the stock? So let's look at the big picture, a couple examples. So I think we're talking about the Orange Grove again. If we were to invest in the Orange Grove, the at-risk would not limit the deductibility of the $25,000 losses until after year 4, because we can't do anything. So the at-risk basis is reduced from $100,000 by $25,000 each of the first 4 years. That's the at-risk, not the passive, the at-risk. Because how much are we at risk for losing each year? $25,000. Can we deduct it? No. But we can deduct our at-risk. All right. However, the passive loss rules prohibit us deducting those losses in the first 4 years. So we're reducing our at-risk, but we can't deduct them. Therefore, based on the facts, none of the suspended losses are going to be deductible until year 6 when we start to make money. So we're going to have $100,000 in suspended losses before we can start. And that's assuming it doesn't lose money in 5 and 6. Exactly. So generally, losses from real estate are treated like other passive losses. There are 2 significant exceptions. 1, real estate professionals and real estate rental activities. Real estate professionals are not rental real estate losses, that's a lot of, are not treated as passive if the following are met. The taxpayer performs more than half of his duties as a real property business in which they materially participate. So, Katie, your example of an apartment complex, that's probably right there. The taxpayer performs more than half as a real property business in which the taxpayer participates. All right.
Does that also include if you work for your own tenants?
That's not going to come into play. You keep bringing that up, but it doesn't matter if they live in it. That's usually part of anybody having a business or having a rental. That's probably a comp, or they pay the rent and it comes out of their salary.
Well, I mean, I had a cousin who rented a room, and she always worked for her own people. She didn't do Airbnb or anything. So would that be considered?
Okay, now you're talking about something different than an apartment complex building in which the owner lives in it. Yeah. Airbnb is not anything what we're talking about right now. Completely different. Airbnb is a rental property, clear and clear, not anything that's going to be materially participated in. Okay? Airbnb is renting out a house. Rental houses are always going to be rental property. Okay? It's all Airbnb is when you rent out either a house you live in or a house that you rent on a regular basis. If you rent a house on a regular basis, you could possibly fall on, but it's not real property. That's personal property. Renting a house is personal property. Okay, so we're not there yet. The taxpayer performs more than 750 hours of service in the real property that they're representing. 2, real estate rental activities. Taxpayer can deduct up to $25,000 of losses on real estate rental activities against an active or portfolio. The benefit is reduced by 50% of the taxpayer's AGI. So, when you rent property that you own, whether it's a rental house and you own a couple of them, or you do an Airbnb, or you have a place down at the lake that you materially participate in, because if you own a place in Florida, you probably don't materially participate in it, okay? You probably have someone manage it. But if you do an Airbnb that you materially participate in, you can deduct up to $25,000 on your 1040. Then you have to stop. Then it becomes passive. Yep.
If you have an own say apartment, a group of apartments or houses or whatever, and you incur losses by you not renting them out, does that have to do?
That's still this, because I have a friend who didn't have a tenant in his house just because he didn't have a tenant in his house for a while, and he had losses. Okay, and so you can deduct up to 25. Plus, if you have that for a little bit, and then you also just have depreciation and other things go wrong, you can lose money on a rental property pretty easily. And so, and once you lose money, if your gains aren't that high, sometimes you lose money for a long time. I had a friend that he's down in Texas now, and I helped him do his taxes while he was here. And it's funny to tell the story, even though it's not really a funny story to him. But his luck with women was not necessarily the best, okay? And on his third marriage, when he got married, his new wife didn't really care for the decor of the condo. So she renovated it. And most of the time you think, okay, she renovated it, right? I didn't see the condo before, and I didn't see the condo after. But they took everything in the condo, and they donated it to, he lived downtown in a loft, and they donated it to a place called the Little Shop Around the Corner. And when you donate to a place like that, they give you the receipt, right? Mm-hmm. His receipt for his charitable donation was $36,000.
Oh, Lord.
If you get a receipt from a place that the value of your things were $36,000, do you know what the actual value of what you spent on them probably was?
$100,000.
So he had a loss, and it's not rental, but he turned it into a rental. So when they renovated it and then started renting it, because of course then she couldn't live in it, when they started renting it, he was able to prorate some of that loss into the renting of it, and he had losses on that place forever. And then he rented it, and he had gains for several years, and then he hasn't been able to rent it for a long time. And he sold it, I think he told me last year finally. But he had losses for years and years, even though he finally got a tenant in, because his mortgage was so high because he bought it at the height of downtown, even though there might be a new height now. But when he bought it, and what he could charge for it didn't what his mortgage was. So he was losing money because he was also paying a management company because he lives in Texas. So he was paying a management company. He had a garage downtown. So all these costs were more than what he could charge for mortgage. So even though he was actually physically renting it, he still had a loss, and he could not deduct more than $25,000. So he discontinued to have a loss. All right, exception 2. Did I go backwards? No. Okay, real estate rental activities. To qualify for this, the taxpayer has to actively participate in the rental. All right, which if you're renting houses out and you're in this area, you're going to do. And own at least 10% of the interest in the rental. Right? So you have to be owner of some part in the rental activity. Active participation defined requires only participation in making management decisions here. So you can be the person who owns it, but you don't have to be the person who fixes it. Okay? So like an Airbnb, you can be the person who makes all the decision and puts it up there, but you don't have the person that goes and cleans it up. And you don't have to be the person who gets it ready and does any of the work. But you can be the management. So let's look back at the facts. Okay. If they invest in apartment rental, their loss would be $25,000. They would be able to deduct this under the rental with the exception that they assume they owned 10% of the activities. The loss would be deductible in each of the 4 years of their investment before exhausting their at-risk. 'Cause remember, their second option was to the department building. Even if they do not have any passive income from anything else, they would be able to deduct that because you can deduct up to $25,000 against active income on your 1040. The bump, go ahead. No, that's together. Yeah. If you married filing separately, only one gets it. All right, so the thing with that one is you could deduct those losses versus the Orange Grove, we got to deduct nothing, right? Suspended losses can be suspended due to loss limits with passive activities or at-risk losses, which we saw with the Orange Grove. Suspended due to at-risk limitations are investment specific and therefore no allocation, and they can be carried forward indefinitely or till you sell it, which is what we saw on the board here. The next couple are not, obviously they're a big deal because the first one says disposition by death, but from a kind of. All right, they're deductible on the final tax return to the extent that they exceed any excess over what's called the step-up basis, which is part of the final tax return, death tax return. If you do it by gift, suspended losses increase your donie's basis. So we had $8,000 of suspended losses. If my basis and your gift that you gave me was $40,000, my basis just became $48. That's because that person, got to claim it. Installment sales we really don't do, but portion of the suspended loss is deductible in the same year as the percentage of the total gain is recognized. That really goes beyond us, but what I wouldn't even worry about it, but basically it's just saying you can't, if you're doing installment sales, you can't take all of the suspended losses at one time if you're only taking part of the gain. Investment interest on these last couple slides. This is talking about interest on loans where proceeds are used to buy investment property. So you borrowed money, you're using those proceeds to buy certain investments. The deductive of that interest is limited to whatever your income was. So if I borrow $100,000 and I go out and invest it in something, I can deduct that interest to the extent that I made money on whatever I invested that $100,000. So for example, this couple that just went out and borrowed $100,000 to invest, they can deduct the interest that they owe on that $100,000 if they made money. Well, what's supposed to happen in the first 4 years of, I think, every one of their investments? So they will not be able to deduct their interest expense on that investment. And do you remember on the 1040, on the itemized deductions, we talked about one of the things was investment expense. It was down under one of the miscellaneous expenses that we probably don't get anymore. But one of them was investment expense. And I think you guys were like, well, what is that? That's one of the items. Net investment income is investment income less any investment expenses. Investment income is from certain dividends, annuities, royalties that are derived from businesses, okay? Not what we invest in, not what comes from our bank, not what comes from our stock, but from businesses that we have invested in. Not the businesses that we run, businesses that, like they did, they went and invested in the Orange Grove. That's investment income, that's investment interest, okay? All expenses directly related to an income are allowed as a deduction. So anything that they have an expense related to the Orange Grove, related to the apartment complex, I don't remember the third option, I already forgot. Those would be deductions against their investment. Should they have a lot of expenses? It was just a portfolio, thank you, yeah. Should they have a lot of expenses? No, because what are they doing with all three in their investments? They're passive, they're buying into something. They should not have a lot of them, but they could have a few things. And then any investment interest disallowed in the current year due to limitation can be also carried forward. Okay, I have a second problem, but I think we're going to be limited on time. So I'll tell you what it is, and then But let's look. So we already said this, most of it will be, investment will be, not be able to be realized. This, this is the first one, sorry. Most of the investment will be consistent of appreciation, however, very little return will consist of currently taxable interest and dividends. So basically, that's any other investment you make, right? If you invest in a high yield, or what they said is a high growth, low yield, we're going to have taxable interest and dividend. The second one, which is the, actually they gave $500, 600. So they actually gave us $500 investment income can be deducted. So is that a lot? $600, $6,000 total in the time that they could possibly make in interest. Oh, is that all they talked about there? Yeah. All right. I'm not worried about that. This is what I thought I was looking at on the other slide. So, high growth, this is what we talked about. So they said 6,000. We already talked about that. Let's look at the after-tax returns from the other two investments are reduced by at-risk losses, and the 8%, I can tell you right now, sounds like a really high yield on both of those things, are contingent on being able to use the tax losses as they appear. So what are we going to tell these people? These benefits will be deferred because of at-risk and passive activity losses, delayed to timing. And since the at-risk and passive activity losses limit the tax, the after-tax return will most likely not be near as high as their broker return. So in their case,